Hey everyone, you're here with Earl the Money Coach, and we're diving into fixed index annuities. What are FIAs? They're very cool financial products that more and more people are starting to talk about. So we're going to give a breakdown, but make sure you like, comment, and subscribe to get more information on annuities. So what is a fixed index annuity? First off, remember they are insurance products. They're guaranteed so you won't lose your initial principal and your initial investment, even if the market goes down. That's huge. The market takes a nosedive, you're still locked in. Why? Because you're linked to the performance of the stock market, but you're not in the stock market. So you get to have a piece of what the S&P 500 does, or whatever market that you have it invested in. You get part of those gains. But if the market tanks, your money stays safe. It's pretty sweet. So how do they work? You have a lump sum, you have a rollover, you want to put your money into a fixed index annuity. Well, it's going to grow based off the stock market's index performance. But understand there's a catch. There are going to be caps, there's going to be spreads, you might have participation rates, certain things that limit your gains. For example, if the market this year went up 19%, you may have a cap of 8%, 10%. Because of these limits, some people may not know how they work. But let's talk some statistics, okay? Fixed index annuities, they're booming with over $50 billion put into annuities every single year in the U.S. alone. That's fixed index annuities, making up about 20% of all the different annuity strategies out there. And over this past decade, guess what? The popularity has grown 5 to 10% every year, year over year. More people are putting money into fixed index annuities. Why? Because there's a lot of pros. You have your principal protection. Your money's safe when the market crashes. All right. You get tax advantages, meaning your money gets to grow tax free into those kind of accounts. So it's super huge. All right. And then you have a potential for higher rates. End of the day, you want to outpace inflation. So great way to give you that outpacing inflation kind of bar that you want to make sure you pass. But the greatest thing about it is lifetime income. Even when the principal's gone, you still get lifetime income within your fixed index annuity. And also, it has a death benefit. So all the rest of your funds could go towards your beneficiary. So those are great pros, but understand there are cons. It could be very complex. It could be very confusing. Many people may not understand how they work. You could have limited gains, like I said earlier, with the participation rate. And yes, there are fees. You may have surrender charges, certain fees, understanding when you need to be able to have access to funds or when you could withdraw your funds. You have to learn all those. And obviously, you have an interest rate risk. All right, if the market's slow, you might not get the return that you're really looking for. And then also, that could lead to inflation risk. Okay, fixed payments are great. And if you might have a fixed index annuity, but guess what? If it's not keeping up with the inflation rate, that could be a con for that year. So you really want to understand how it's used. And that's why the wealthy use a lot of it. Now, why do a lot of wealthy folks use fixed index annuities? Because they want to balance their portfolio. You want to have your eggs in different baskets. You want to be able to secure retirement income, ensuring that you have income coming in no matter what. But a lot of times, wealthy folks want to take advantage of the tax advantage strategy that you could implement with your fixed index annuities. So that could be huge. And obviously, a lot of wealthy folks and a lot of my clients use it for lifetime income. You want to make sure that you have supplemental. We call that supplemental income. Something that you could use to supplement your income for the rest of your life to make up for what you had when you were working. All right, that gives you a peace of mind knowing that you're never going to outlive your money. Now, a lot of people say, Earl, that sounds like a pension. Well, there is a difference. Because remember, when it comes to a pension, a lot of pensions are employer-sponsored plans, not you putting it in, your company putting everything in. So it could sound good and it could be funded mostly from them. But guess what? That could also make it a hardship for your employer. This is why a lot of times you see pensions are starting to go away. Okay? So you can't get guaranteed benefits in your pensions, but if something happens, what are you going to do? But it's good to know that the pensions are protected by the Pension Benefit Guaranty Corporation, or PBGC. So that's great. And it also, what does a pension does? It gives you fixed income for life. Kind of gives you that lifetime income. But remember, the risk is with the employer. The employer could shut down that pension strategy if they see it's no more deemed necessary for them. Now, fixed index annuities, guess what? It's an insurance, so you still could get that interest, but instead of being funded by your company, it's being funded by you. You're funding it yourself. All right. So I kind of call it your personalized Social Security. But a great thing is you have a guaranteed protected principal through an insurance company, and it also allows you to have flexible payout options. You could do a lump sum, you could do periodic, you could do lifetime income, a lot of things in your fixed index annuity. Now, obviously, there are risks because you're going to bear the investment risk, but you know your principal is going to be safe. Okay. Now, the key difference between a pension, like I said, and a fixed index annuity is how it's funded. All right, pensions are funded by the employer, fixed index annuity is funded by you. So it gives you more control of what you want to do. And that's huge if you want to have a retirement. You want to have control on what your retirement is so you can get the greatest bang for your buck. Because if the employer is taking the risk, guess what? If the risk is too great for the employer, they may take that pension away from you guys. I've seen clients before have that happen where they worked for 18, 19 years, expected a pension, and then the company took the pensions away. So, in conclusion, I would say fixed index annuities are great if you're looking for something safe to be able to invest and have the potential of having lifetime income or creating your personalized pension. So it's a great way you could have everything where it's linked to an account where you're not worrying if there's going to be a con for a down year. Because remember, it's not about how much money you make, it's about how much money that you keep. And that is a huge thing. A lot of folks get ready to retire, but then something happens, and then guess what? They may lose some of their retirement. They may lose some of their investment. So having a fixed index annuity gives you that chance to be able to really have everything set in motion for yourself, by yourself, and you know what to do everything. But remember, there's always going to be pros, there's always going to be cons, there's only going to be risk. Always going to be risk. So you want to make sure you understand all of that. And this is just an intro. I'm going to dive deep into how fixed index annuities really work. So make sure you like, comment, and subscribe. And click the links below in my description, as we have some links there to give you some life insurances and give you other things that could really benefit yourself as well. So take care. You're here with Earl the Money Coach, and I'll see you at the top.